Welcome class to the online lecture series of ECO 432 Money and Banking. I hope by now you have received my email and read the course outline which has been uploaded. Make sure before starting this lecture you go through the previous lectures since all the topics are interrelated, so it will be difficult for you to understand the upcoming topics if you are not familiar with the previous lectures. The reference reading for today's lecture would be Chapter 2, Introduction and Overview of Financial System by Friedrich Mishkin, The Economics of Money, Banking and Financial Market. So in the previous lecture, we saw how we distinguish the financial market in terms of maturity of the security, and for that we divide the financial market into two markets, the money market and the capital market. But the money market offers short-term maturity securities which has a maturity of less than a year, and on the other hand, capital market sells securities that has a maturity of more than a year. So in this lecture further, we shall be looking on to varied kinds of money market and capital market instruments that are available in the market for the sellers and the buyers to invest. There are various kinds of money market instruments. The most common type of instrument is treasury bill. These are the safest form of money market instrument. So short-term debt instrument, these securities are backed by the government with a maturity of less than a year. And since it is issued and sold by the government and the government cannot default, that is why it is the most safest form of money market instrument. And this treasury bill, they pay set amount at maturity with no interest payment. However, they are sold at a discount from face value. Now, what does that mean? So, I hope all of you know what is the face value of a bond. A face value of a bond is the price below which a bond cannot be sold, or in other words, the face value specifies a minimum price the buyer has to pay in order to buy a share. So, more on face value will be added in the lecture notes. Currently, Bangladesh Bank is issuing different maturity money market instruments, mostly the treasury bills, and there are 14 days, 13 days, 91 days, 182 days, and 364 days treasury bills currently issued by Bangladesh Bank. And all of these treasury bills come under money market because all of them has a maturity of less than a year. Another type of money market instrument are the certificates of deposits. They are commonly sold by the banks. So in Bangladesh, almost all of the private banks issue certificate of deposits to their customers. And this certificate of deposits pay annual interest to its buyers, and at maturity original purchase price is paid. So they act as like holding a bond, but then again, since it is only sold by the banks, that is why we call them CDs or certificate of deposits. So as opposed to the treasury bills where we do not get any interest payment, rather we get the face value at the end of the term. In the certificate of deposits, there is a maturity upon which you would be getting your original purchase price, plus you would be getting annual interest depending upon the frequency of the payment that is stated in the bond. And there's another type of money market instrument, that is the commercial papers. They are issued by both large banks and well-known organizations. They are usually sold at a discount from face value and generally carries lower interest repayment rates than bonds. Now, this feature is similar to the treasury bills where the commercial papers are sold at a discount rate and then the face value. Also, commercial paper is not usually backed up by any form of collateral, and since it is not issued by the government. That is why collateral plays a very important role here. And since the commercial paper does not pay any collateral, meaning the buyers they are not fully guaranteed to get their money after its maturity. Rather, it becomes much more riskier than the treasury bills, and that is why only firms with excellent credit ratings will be able to sell at a reasonable price. Because if you are to risk your money and if you are not given any collateral, in that case you would be pledging your money into a firm which would be much more certain to repay you back, and this kind of trust can only be placed on large organizations and large commercial banks. The proceeds from this the process from this type of financing can only be used on current assets like inventories or cash items and are not allowed to be used on fixed assets. So large banks and organizations occasionally issue this type of commercial paper in order to fulfill their current asset requirements, and they usually do not use it for fixed asset requirements. Another form of money market instrument are the repos, which are repurchase agreements. A repurchase agreement is a form of short-term borrowing for dealers in government securities. In case of a repo, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day at a slightly higher price. For example, if today Unilever holds 1 crore taka worth of government bond, it can then, with the help of its dealer, sell those government securities to its investors. And after issuing those securities, Unilever agrees to buy those securities back at a future date but at a slightly higher price. Thus, the repos are short-term loans which usually have a maturity of less than 2 weeks. And here, the T-bills serve as a collateral. Why? Because in case Unilever fails to buy back those securities, the buyer or the investors in that case still have those T-bills which they can then sell out to others. Large organizations are the most important lenders in this market because they hold enormous amount of repurchase agreements, because they automatically hold a lot of government securities to secure themselves from the coming cash needs. And this kind of money market instrument they serve as the most liquid type of instrument because they enable the borrower to take loan on an overnight basis and for a very short period of time. Bangladesh government recently launched a special repo to stimulate investments during COVID pandemic. Under the newly introduced special repo facility, the banks, all the private banks I mean, would be able to avail credit directly from the central bank at around 6% interest for 360 days. The window was previously 28 days. A large window that enables the banks and other non-banking financial organizations to borrow money from the bank and keep on the crediting facility running. More on this issue has been linked down below. Another type of money market instrument are the federal funds. Federal funds are often referred to as Fed funds. Now we need to understand what do we mean by federal. So federal funds come from the name of USA Central Bank, which is Federal Reserve System, or in short Fed. So by federal funds we mean the funds that are available through the Central Bank of USA. And since we are following a North American book written by a North American author, that is why most of the scenarios which are discussed in this book are referred to US economy and its banking system. However, if you try to relate this concept with Bangladesh economy and Bangladesh Bank, the situation is as such. These federal funds are basically funds that are available in the private banks in terms of government security. So, as of the central bank's regulation, in Bangladesh, each and every private bank needs to hold a certain amount of reserve with the central bank. And these reserves, as you know, I'm sure, are known as required reserves. Apart from holding these required reserves, the bank occasionally hold excess reserves so that they can safeguard themselves from the upcoming financial crisis even. And if the banks are holding a lot of excess reserves, one way they can use this excess reserve is by lending it to some other private banks on an overnight basis. So, for example, if you consider two banks, BRAC Bank and say Standard Chartered, so if BRAC has huge amount of excess reserves apart from the required reserve in its account, it can then lend it to SCB if it needed. And if SCB is falling short of reserves, the required reserves, as I said, by the central bank, in that case, SCB can borrow required reserves from BRAC Bank at a certain rate of interest. And this interbanking lending and borrowing is known as federal funding system. And the interest rate that is charged in this interbanking loan is known as federal fund rate. And this is the rate that is usually fixed by the central bank, and there is a minimum federal fund rate under which a bank cannot be charged. So this federal funding system enables private banks to still maintain their reserve requirements if they fall in short of those requirements. Because as you know, to successfully operate in the banking system, each and every private bank must abide by the rules and regulations set by the central bank. And one such regulation is that they hold a certain amount of their money as excess reserves. And if they fall short of this excess reserve, they can still meet those requirements by borrowing from other banks on an urgent basis.